97% of the global money supply is actually debt. Most individuals believe that currency is printed by central governments and distributed into the economy. But the reality of the money creation cycle is far more complex and involves a symbiotic relationship between private banks and the public. Understanding this mechanism is essential for anyone seeking to comprehend how wealth is generated, scaled, and preserved in a modern financial system. This analysis breaks down the four distinct stages of the money cycle, from the moment a loan is signed to the point where capital transforms into tangible assets. By the end of this deep dive, the hidden architecture of the global economy will be visible, providing a clear perspective on why some sectors flourish while others stagnate during periods of fiscal expansion. The cycle begins not in a government mint, but within the walls of commercial banks through a process known as fractional reserve banking. When a customer deposits $1,000 into a checking account, the bank is typically required to keep only a small fraction, often 10%, as a reserve while lending out the remaining $900. When that $900 is lent to a small business owner for equipment, it doesn't vanish from the system. Instead, it is deposited into the equipment seller's bank account, where the cycle repeats. This effectively creates new money in the form of digital entries, expanding the M2 money supply, which includes cash, checking deposits, and easily convertible near money. Data from the Federal Reserve shows that this multiplier effect can theoretically turn a single dollar of base money into $10 of circulating credit within the economy. This expansion is what fuels the initial growth of industries, providing the liquidity necessary for companies to hire staff and purchase raw materials without waiting for years of accumulated savings. However, this system relies entirely on the trust that the loans will be repaid. If the rate of default exceeds the bank's reserves, the cycle begins to contract. In a healthy economy, the perpetual creation of new credit keeps the gears of commerce turning. But the cost of this liquidity is the interest paid back to the institution that facilitated the creation. As the money supply grows, the value of each individual unit of currency tends to decrease unless it is met with a corresponding increase in productivity. This is why economists monitor the consumer price index and other inflation metrics to ensure the rate of money creation does not outpace the actual output of goods and services. But here's where it gets interesting. The creation of money is only half the story, as the true power of capital lies in how quickly it moves through the system. The velocity of money is a measure of how frequently a single unit of currency is used to purchase domestically produced goods and services within a given time period. High velocity suggests a robust economy, where consumers and businesses are confident enough to spend and invest, while low velocity often indicates a stagnation in economic activity. During the mid-1990s, the velocity of the M2 money supply in the United States peaked at approximately 2.2, meaning every dollar moved through the economy more than twice a year. In contrast, during periods of economic uncertainty, this figure has been known to drop significantly as institutions and households hoard cash rather than deploying it into the marketplace. When velocity is high, the money creation cycle reaches its peak efficiency, as one person's spending becomes another person's income, which in turn becomes a new deposit that can be lent out again. This virtuous cycle allows for rapid wealth accumulation across various sectors of society, from retail to high-tech manufacturing. If the velocity of money remains low despite a high supply of currency, the economy may experience what some call a liquidity trap, where traditional monetary policy becomes less effective. In this scenario, even with interest rates near zero, the cycle of money creation stalls because there is a lack of demand for new credit or a lack of confidence in future returns. Sophisticated market participants look at velocity as a leading indicator of inflation. If the money supply increases and velocity also picks up, prices for assets and commodities typically reflect that increased demand. The goal of a balanced economy is to maintain a steady flow of capital that supports growth without causing the system to overheat. The data tells a different story when we look at where that capital actually ends up, shifting from liquid currency into the world of tangible production. For money to maintain its purchasing power over long horizons, it must eventually be converted from a medium of exchange into a productive asset. This is the stage where liquidity is used to fund research and development, build infrastructure, or launch new enterprises that solve specific problems for profit. When a corporation uses its capital to invest in a new automated fulfillment center costing $200 million, it is taking liquid money out of the cycle and locking it into a physical asset. This asset is expected to generate a return on investment that exceeds the cost of the capital used to build it, thereby creating true economic value. This transition from currency to capital is what separates long-term wealth from temporary income. Assets like real estate, intellectual property, and equity in profitable companies are the end goals of the money creation cycle. These assets provide a hedge against the natural inflationary pressure created by the continuous expansion of the credit supply. In the technology sector, for instance, venture capital firms have poured over $300 billion annually into startups with the hope that these companies will create new markets. While many fail, the few that succeed create massive efficiencies that allow the entire economy to do more with less, which is the ultimate definition of wealth. The IRS reports that the majority of high-net-worth individuals derive their wealth from asset appreciation and business ownership rather than traditional wages. This suggests that the highest tier of the money cycle is reached when one stops chasing the currency and starts owning the mechanisms that produce it. However, as capital becomes more concentrated in assets, a new challenge arises: maintaining the stability of the entire financial architecture against external shocks. The entire money creation cycle is subject to what economists call the long-term debt cycle, a period typically lasting 50 to 75 years. During the upward phase, debt grows faster than income, leading to an asset bubble where prices for housing and stocks reach levels that are disconnected from their fundamental earnings. When the burden of servicing this debt becomes too heavy for the average borrower, the cycle enters a period of deleveraging, where banks tighten lending standards and the money supply begins to contract. This is often characterized by a decrease in consumer spending and a sharp correction in asset prices as the excess liquidity is drained from a system. History shows that the most resilient economies are those that can transition through these cycles by balancing fiscal policy with private sector innovation. Central banks may intervene by lowering interest rates or engaging in quantitative easing, which involves purchasing trillions of dollars in government bonds to inject fresh liquidity back into the banks. For the individual, understanding these macro cycles is the key to timing the transition from aggressive growth to defensive preservation. During periods of high interest rates, debt becomes expensive and cash becomes more valuable. Conversely, when rates are low, the incentive is to move out of cash and into productive assets before the next wave of currency expansion occurs. The cycle of money creation is not a straight line, but a series of waves, and those who study the ebb and flow of credit are better positioned to navigate the shifts in the global landscape. It is a system built on the future promise of labor, backed by the physical reality of production. In the end, money is simply a tool used to organize human effort, and its creation is the starting line for all modern business endeavors. The most important insight to remember is that wealth is not found in the currency itself, but in the productive assets that the currency is used to build and acquire. If this changed how you think about the global financial system, the next video breaks down the specific strategies institutions use to protect their capital during periods of high inflation.